All right. Hello, everybody. I am Mike Castle, Senior Commodities Economist here at StoneX. Wanted to bring on an energy guy to yell at here from the ag perspective, joined by the Alex Hodis.
Hi, I'm Alex Hodes. I'm Director of Market Strategy for the Energy team. So glad to be here, Mike.
Yeah, absolutely. And obviously, it's kind of hard to believe we're already in the middle of August. It'll kind of be harvest season before we know it here in the Midwest. And a lot of talk in the energy markets. Obviously, there's plenty to cover that Alex has done so very well. And a lot of focus kind of on the crude oil side of things. I kind of wanted to tie this back into the ag markets, kind of more from our perspective over here. And really, I would say the big focus is in the diesel market. Obviously, we've seen diesel prices spike here pretty considerably. Refining margins are obviously gigantic. We have kind of rebounded, it seems like, fundamentally, at least in terms of distillate stocks. So I guess one thing that kind of kicked this off for me, and I put together a graphic on this, is seeing the price per gallon of Midwest average diesel surpass D's corn futures, obviously priced in dollars per bushel. And that kind of just, a big story in 2026 has been the fertilizer side. But what I don't think we've heard talked about enough is that strain in the diesel market. So I kind of wanted to get your perspective on kind of how we've gotten to this point and where you think we're kind of moving here through the rest of 26.
Yeah, I think first off, it's great for somebody to finally recognize diesel coming up because everybody's always talking about crude oil, gasoline, and really the story here that's been kind of in the background has been diesel. And there are quite a bit of factors that are going into it, one of which has just been the refining capacity globally has been kind of constrained over the past several years. We saw in 2022, diesel prices really shot up, and we're kind of back to where we had been in 2022. And starting this year, we saw a big winter storm kind of come through in January, February time period, and that tightened up diesel supplies. So we had been kind of healthy headed into the year, and then we saw that. And then obviously the world kind of flipped on its head and the Strait of Hormuz was closed. There's quite a bit of refining capacity there. A lot of that crude oil is very distillate rich, meaning the refiners can really pull out a lot of diesel from those crude grades. And where that crude typically goes is to the Asian refineries. And then they are big producers of this distillate fuel. And then on top of that, we've seen the attacks on Russian refineries. So Russia used to be kind of one of the biggest suppliers of diesel globally, and you've seen diesel exports being banned from Russia, and that's really tightened things quite a bit even further. So diesel prices are really the ones that are kind of outrunning the rest of the complex. Diesel crack spread, so meaning refining margins for crude oil to make diesel, are at all-time highs, approaching $100 per barrel. So really, that's just showing this constraint on the refining capacity globally and how it is diesel inventories are so tight and the possibility or potential to make more diesel supplies globally is very constrained.
Gotcha. Yeah. And obviously the price action kind of makes sense with that. And we've kind of seen crude decouple from a lot of the refined products in the last couple of months. And again, obviously, when you're talking about the ag sector specifically, every time you're firing up a piece of machinery, you're burning diesel. But also just as a consumer, anything that we're going to eat or wear or anything that we're consuming is moving on a truck at some point. So this also kind of has that macro effect, like the broader inflationary story can, in my opinion, probably cause a bit of a longer tail because that stuff kind of takes time to get passed along, essentially. So there's kind of a couple different ways to look at it. But do you think at this point, is geopolitics at this point kind of like the biggest limiting factor for like diesel exports globally resuming?
I would say yes on the margin, but things are tight in general already. So there are not really any additional refineries that are expected to be built. So we in the very near term, and those are things that take years to happen. So really, we're going to be in this constrained environment for kind of the near term. Even if the Strait of Hormuz opened up, yes, we'd see some temporary alleviation, but then you run into kind of spikes of diesel demand, and that's going to put that refining capacity under constraints again. And I would say that, like you said, this is something that's kind of going to be an undercurrent in the market, and it's going to kind of make everything more expensive overall, and you're just not going to feel it initially. And that's one of those things of why gasoline kind of takes the headlines, because consumers see that price tick by tick every day. They drive past the pump, they fill up, they know how prices are moving higher. But then in the background, you have diesel prices that nobody really looks at. So it's kind of one of those things where it's kind of just climbing in the background and nobody's really talking about it as much. And it might be one of the biggest impulses and kind of causes of inflation, perpetual inflation or persistent inflation over the next several years, honestly. One thing in particular, we're discussing a little bit about the Midwest and harvest season. One thing in the Midwest is that Midwest diesel prices, with respect to where New York Harbor diesel prices are almost at historical lows seasonally. So you're kind of running into two things that don't really add up. So one, that tells you that a lot of the diesel prices are being guided by kind of these global dynamics, but inventories are still tight in the Midwest. So I think there could be a cause for reckoning on Group 3 ULSD pricing. So that is the Midwest pricing for diesel coming up.
Yeah, and that kind of gets to this, ugly spot of, I also put together, like, we like to talk about our fertilizer grain ratios, which you're just trying to say how many bushels of, corn, for example, does it take to buy that 1 ton of urea is what we look at a lot. So I also did the same thing on the diesel side of things, just looking at Midwest pricing specifically. And this is quite ugly. I mean, just to kind of put it simply, I kind of put together a seasonal chart looking at this year versus the last 10. It's easily the worst it's looked in that time frame. If you look at it from a time series, I think like 2007 or something like that, like the late aughts was the last time we saw these kind of levels. But obviously that kind of, you're saying that there may be some reckoning there. What do you think the, I guess, positioning in like the physical market at this point is? Specifically, again, tying it to ag more in the Midwest. How do Midwest fundamentals look like, from the supply side versus the demand side today? Obviously, with, again, harvest season kicking up here in the next month or two.
Yeah, so there are a couple factors here. One, and this is honestly just from some of our clients, just kind of word on the street, that people are sitting pretty low with regards to their fuel inventories. So I think there could be kind of a big surge in demand here ahead of harvest. And in addition to that, there are several refineries that are expected to undergo maintenance. This is the time of year where maintenance usually occurs, is kind of in that fall period. And what you typically see is, so the Group 3 basis, which is the price differential between Midwest diesel prices and New York Harbor diesel prices, it tends to start strengthening into September and October as you start to see, one, refineries go on maintenance and then demand start to pick up. And I think that right now you're going to see perhaps an even larger demand impulse because people are sitting pretty tight on their inventories from a physical standpoint. So I think it would be wise to kind of perhaps jump out ahead of this and make sure you're kind of filling up when Group 3 pricing is still at this differential of, I think it was minus 18 cents. So quite a bit of differential basis is extremely negative right now. And I could see that typically around this time of year, September, October, goes to 7 or 8 over. So quite a big amount of room there that you could see prices move higher. That's not to say that diesel prices can't come down. I think, they move headline to headline, but it's just we're showing kind of this mismatch of fundamentals are tight and we're seeing kind of a looser pricing environment in the Midwest specifically.
Okay, that's really good info. That's good to know. And I guess lastly, in the US, and again, like obviously I'm kind of coming at this from the perspective of like ag inputs. So in fertilizer, especially something like nitrogen, for example, effectively what we've had in 26, because we do have like less exposure to the strait on the nitrogen side, at least compared to a lot of people when it comes to nitrogen, uh, is we really just have an affordability problem, not an availability problem. Like we're not in a position of we're not going to have the tons. It's effectively just a function of the domestic market having to pay enough to keep those tons here instead of being exported. Is it a similar situation in diesel, obviously, with someone like Russia being out of the market, at least temporarily? Does that shift more demand to the US because we're such a big producer?
Yeah, I mean, honestly, it's a pretty much the exact same scenario in that the US is a net exporter of diesel. We export nearly 20%. At certain times, it's more than that of what we produce. So we overproduce diesel domestically. And really, the thing is more about getting diesel to the right spots. So the refining complex is in the Gulf Coast area. There is some refining capacity as well in kind of the Midwest. There's some in Chicago, upper Midwest, and then Oklahoma area as well. So those are kind of a little bit more tied to that market, but we are not going to run out of diesel. So if you see those headlines, that's usually a sign that we're approaching the top. So I think that's kind of what we saw in 2022. But really what's going to need to happen is that prices move higher to kind of keep that diesel at home. Right now, we're still Gulf Coast exports of diesel are hitting record highs. So we could see some of that ease back if Russia starts to kind of export more diesel, but that's going to be an ongoing issue. Ukraine has stepped up their attacks more towards kind of tankers as well as export terminals. Really, no Russian oil infrastructure is safe. And so that persistent risk needs to be priced into the market as well, as the US is kind of that marginal supplier on a global scale.
Awesome. Man, that's really good info, Alex. Thank you very much for joining us here. Thank you guys. Please make sure go find us on YouTube at StoneX_official. And thanks again.